Welcome to the As Yet Unknown podcast. My name's Alex Snyder, your back pocket coach consultant and connection catalyst. Entrepreneurship is a bit like bungee jumping, a big leap into the unknown, and it can be a lonely, bumpy ride. It's also one of the most empowering and liberating things you can do. Each episode is a dose of fresh perspectives designed to leave you feeling connected to innovative ideas and inspired about growing your business your way. Thanks for tuning in. Now let's have an adventure. Thank you for everyone joining. David, welcome.
Thanks.
Thank you so much for being here. We go pretty far back. You're rivaling for one of the longest sort of knowing each other guests, back to the early days of our consulting careers. I won't put a date on that, but actually can't remember if you joined before the acquisition or after?
No, right after.
Okay. Anyways, you've had quite the journey and ultimately founded Boreal Ventures, your own venture capital fund based in Montreal, focused on the deep tech space. And I am so excited to have you here for your knowledge, of course. I think it's going to be a really exciting and informative discussion for so many people around investing and fundraising, especially in our evolving economic climate, recession. And also because I do think there is so often a perception of venture capital or private equity or leaders in the finance space being really stereotypical, really hard-edged Wall Street greed types. And while, of course, and let me just start off by offending you. Of course, making good calls in investment-wise in the space is key to a fund's survival. When you and I talk, you are always, you're a fairly gently spoken guy, and you are always so excited about the possibility of the tech from your portfolio, like changing the world and saving people's lives. And you're always nerding out on the tech. And I find that I love our conversations and I find them so inspiring. So I think that having that side of the business and that energy really coming out and for people to understand that, I think is a really exciting opportunity as well. So I don't know how many times I can say I'm excited about this, but I would love for you to add on to that intro, tell people a little bit about your journey and how you've got to where you are today.
Absolutely. So first of all, thank you very much for having me. It was great working with you, and when we reconnected recently, and you asked me to be having this conversation with you, I jumped on the occasion. I mean, it's always fun to discuss together. So I like I like your intro about the Wolf of Wall Street and all this dynamic around financial world. I don't come from the financial world either, right? I'm an engineer by trade, bachelor and master. Although I wasn't that great of an engineer, I like being that bridge between the technical people and the business world. And I didn't know my career. I didn't even know what finance was back when I was studying, right? I just loved the idea of technology, how it's shaping out the world. And one thing led to another. I joined same firm as you, our time at KPMG. It was great because it got me to learn about business and give me sort of like an accelerated MBA, being hands-on into the governance of businesses, looking at strategy and whatnot. So from there on, after a few years, realized that I had enough. I learned what I had to learn, and then jumped to venture capital, where again I had tremendous mentor that sort of taught me about the business world, the financial world, how deals are structured, what makes a good deal and whatnot. And one thing led to another. I was given this opportunity to launch a fund linked to a well-renowned incubator here in Canada, around the deep tech space, which is the space I come in. So essentially that bridge between science, engineering, technology in the business world. And all of a sudden, my entire career sort of start making sense, right? You can only connect you can only connect the dots looking backwards. And this is a kind of saying that it makes sense when you're 20 something, but then you get to a certain point, it's like, oh, okay, yeah, well, all those decisions that I wasn't sure make sense now sort of align. It creates a narrative, and now you can sell it as this was the master plan from the get-go, right? So yeah, and the second part about what you were mentioning, I love the part that you're saying that I'm super excited about tech because I genuinely am. Um, honestly, I see technology and I see technologists more broadly as being sort of like the builder of the future, right? They're putting everything on the line to go launch a startup, to go build something, go build their vision. So there's something empowering and yet that comes with an immense amount of respect for the entrepreneurs, putting everything on the line and wanting to make a dent, right? So where I position myself is in the deep tech space. So anything medical, so medical devices, digital health and whatnot, that is using, you know, science and engineering to solve big problems. And same on the industrial side as well. So again, very broadly, future of work, quantum photonics, or even, just industrial technology more broadly, IoT, 5G and whatnot. So it's the, the aside from spending time with the entrepreneurs and being sort of an enabler to their vision, I love the fact that venture capital is more or less the insurance policy of the future. It's the insurance policy for corporates to stay relevant, to make sure that they're not being, scooped by a new, more agile company, uh, rendering them useless in the market from a technological standpoint. But also as a society, this is the very tail end of where capital ends up going. So it's riskier bets, but that is essentially creating the future of tomorrow. So we may not have flying cars. We have a shit ton of SaaS businesses instead, but it's still building out the future. And this is the part that you know, that's the how can I say? That's one part of my job that I find is really fun.
So no flying cars in your portfolio at present.
No, no, unfortunately. Although, there are a bunch of cool ideas like that are just not fundable, right? That's
Mm.
when you realize when you become an investor, there's certain cool, geeky things that you would love to throw money at. But the problem is the market's not there yet and there's no pool. So this is a big part about my job, being more of a generalist in the sense that I looking mostly at Canadian deal flow. I cannot have a thesis that is very narrowed down into a given industry. I need to read market signals as much as possible. And it
Mm.
makes it so that, I cannot be the mover and shaker of some of the largest VC funds in California that are essentially shaping that future. So on my end, I'm mostly looking for market pull and instead of market push. So it's the idea of essentially providing a solution for a pain point that is very well defined in the industry, and that startups already sees commercial traction by providing a solution to such problems. So within the confine of deep tech, this is usually this dynamic of push versus pull that I'm trying to assess. Because I'm meeting with PhDs on a regular basis that have like some of the best research in the world, are creating tremendous things, but are just not fundable, right? Because they're trying to geek out on something and push their new technology to the market, and they're always one step away from thinking that they can make it big. But at the end of the day, if the market doesn't care for what they're building, there's no business there.
Right. That's such a good point, is understanding, there are different players in the space, right? There's PE, there's VC, but then there's also the role of like the eccentric billionaire who's like got a passion project that they can just like push and fund without the timeline and the returns and the pressures that a fund has, right? Like the responsibility to your stakeholders is different than somebody who is independently wealthy and just passionate about something and willing to kind of pursue and pour into that. And not to say that you wouldn't love to do that, but I guess it wouldn't be the responsible thing to do with the funds from the people who have invested into you, right?
No, it's a very good point. So at the end of the day, although I can geek out and I got the chance to spend time with tremendous entrepreneur and trying to enable them into their vision. At the end of the day, I need to return capital. If not, there won't be any fund two, there won't be any fund three, there won't be I won't be able to do this job that I like so much.
Yeah.
So all of my decisions have to be taken into the confine of returning capital to my investors. And usually with venture capital, you're expecting outsized returns, right? So usually for venture funds such as myself, the minimum threshold that we're aiming for is 35% IRR. So again, every single bet that you're taking, every single investment needs to have that ability to create outsized returns for the portfolio. So that assessment of risk versus opportunity creates in itself a portfolio that can be divided into two parts. So 4 years for an investment period, 4 to 5 years, where you're picking out, your company, building a portfolio of different companies that with different level of risk that sort of like counterbalance each other. And afterwards, you have the maturation period where for 5 to 6 years, in my case, I have optionality of 2 additional years as well, where you're hoping for those companies to mature and get to a liquidation event. So either an IPO, either an exit, buying you back in secondaries and whatnot. So that is the game I'm in, right? So every single time I'm looking at an investment, I'm trying to think where they are in their maturity, and are they at this very beginning of an inflection point that within months, within years, I will see significant commercial traction or market response that will increase the value of my position and essentially, help us show the traction to eventually become a bit bigger platform and help more entrepreneurs.
Yeah. I want to just take a moment and pause there, because I think that's a really, really important point around understanding how VC works. And for anyone who's listening, who's maybe not as familiar, what you were essentially saying is, you have to be able to come in at a time where you see the opportunity, but you're coming in at sort of an investment price where the company is going to return something that is, well above an average market investment, right? So you were saying, minimum 35% IRR. And feel free to correct me here if I'm like, of course, or you want to simplify it even more. But basically, there's kind of a phase. So if you were to pitch, you would want to show that there's going to be a 4-year kind of consumption of capital, use of funds to build and pivot and adjust, and that in years 5 and 6, the company is going to be at a point where it is earning beyond a break even, hopefully. And also finding a way for you to actually get your money out of that company, right? So like you said, an IPO or a sale or some other way that you can actually essentially exit the company, or at least partially exit the company. Is that fair?
Right. Yeah, exactly. So just to put more clarity on those points, company, when we come in, usually either show some commercial traction but want to accelerate it, or are developing, in the case of medtech, something very precise that is targeting a very, very large market, and they have sort of a stage gate approach where they're doing clinical trials and they get increase in valuation because as they progress, their risk, decreases. And that element of risk is at the very core of, venture capital. So it's always the balance of trying to price in the risk that the businesses has in the future, and essentially price it at a price today where you are taking into consideration sort of like how much capital will need to be raised, right? So capital requirements, also commercial risk, technical tech risk in itself, R&D risk, and whatnot, and trying to scale it back to a price point, an entry point into which you would be able later on to provide outsized return as you are converting your shares into money. So money into shares, shares into money, because that's the problem with venture capital, right? Compared to public market, your capital is essentially tied up for close to 10 years, right? So it's very patient capital. And the only thing we know is that the thesis, or what you identify a risk at the very beginning, the odds are that you have identified every single risk are slim to none. The only thing you know is that you're sailing off to sea and you just don't know what's going to happen. So it's very important as you're coming into an investment that you're you're choosing essentially the shit sandwich you want to deal with. Do you want to deal with technological risk? Do you want to deal with more of a commercial risk? Is
Mm.
this going to be more of an HR risk that you need to build out the team and whatnot? So every single time we're getting into an investment, we're doing everything we can to try to limit those risks by usually bringing in more people into the company and whatnot, a little bit like a PE shop would do, right? P and
Mhm.
VC are very similar in that sense that they take a sort of a hands-on approach towards investment and try to augment their investment or de-risk some of their position by adding on additional people to work with your founders. But I digress. So it's this idea when you're coming in of identifying the known risk, taking into account that there will be unknowns that you don't know anything of that may
Right.
arise. But at the end of the day, you know, you're sailing off to sea with a founding team, with a team, and you will be stuck together for close to 10 years in some cases. So you got to make sure, and this is actually part of this whole diligence process, that as you are sort of like flirting with the entrepreneur, right? As you are getting to know each other, you can see the limit of the personalities of the individuals, and you want to make sure that you will be able to work together for years to come because you're stuck together in the middle of the sea afterwards.
Yeah.
So this is
I love
why,
that
even,
analogy.
well, I mean, you
I,
can take the wedding approach, sailing to sea, whatever it
that's
is.
the one I use is, I was recently in a conversations with some founders who are, on the road to venture, and they were talking to me about advising or maybe joining. And I was like, guys, this is a 6 to 10 year commitment. It's like a marriage, like
It is.
you gotta know each other. You gotta figure out, if you're ready to kind of jump in with both feet. And I think, it's the same thing if you're founding or if you're investing. But yeah, I use a lot of ship analogies as well. So
Well, there's this big human component around venture capital that is not very often discussed, right? We keep having those ideas of those unicorns and whatnot scaling, but what they don't know is that, behind the scenes, it's a shit show. There's those board meetings where everything's going sideways, shit hit the fan because you're losing a customer and whatnot. You can't fundraise. So at the end of the day, at least in my case, given that I still have 35 years of career ahead of me, I have this chance of, selling a commodity capital. I'm trying to tie in with some brand equity around it, right? But the biggest pleasure that I have is essentially choosing who you want to work with. And this whole diligence process at the end of the day can be resumed into the simple point of whether or not this person convinced you to come work with them. So it's almost, a reverse interview pitch up to a certain extent. And when you come to see it this way, it's like, okay, it's like a big interview. It's like I want to put my network, at play, our money at play, and whatnot, and be working together. It's very very human. It's
Mhm.
because honestly, venture capital, there are just so many things that you don't know about. That
Yeah.
the only foundation you can rely upon is sort of like the feedback loops that the founder create to solve problems and how they will react in the future. So even on the due diligence for us, it's important to take the time to build a report with the entrepreneur and ask questions around, how they solved problems in the past, because usually that is a good predicate of how they will be solving problems in the future, how they think about problems,
Mhm.
how they approach, how they're being humble about it, how coachable they are and whatnot. And this whole idea of coachable is just creating a discussion, right? And making sure that both sides are listened. Because again, we're talking about a marriage almost. So you
Yeah.
want to make sure that you're creating the foundation of something that you can grow with over time.
I love that. Okay, so I want to think about the stages. I'm trying to make sure we're covering your perspective for all the stakeholders that are out there. So I think if we think about it, like you need to raise money first, then you get to invest, then you get to manage.
Yes.
So you manage a VC fund representing investors. All the
Yes.
things that you just talked about is you doing that on behalf of your investors in a given fund. So I feel like the obvious question to start with that's on people's minds in general, even if they're not an investor in venture
Mm-hmm.
capital, is it a good time to invest? We're in a recession. What do I do?
Okay, two parts to this question. So I'll come back to the first part around, the fundraising. I'm an entrepreneur just like the other entrepreneurs that I'm meeting with. Just so happen to have a bit more, runway than they do. A fund usually is 10 years, but it's the same thing. I pitch to LPs a vision, something that we're building, an opportunity, and that will lead into the second part of the question. But just to close on that, on one end, I'm a little bit like a marketplace. I'm pitching a certain idea, and then on the other side, I'm meeting deal flow and I'm allocating this capital and I'm managing it on behalf of my LPs. And every, 2 to 4 years, I go back to my LPs, ask for more money to reinvest and starting, nurturing this portfolio, a new portfolio essentially. But coming back to the second point around is now a good time? That is a very, very broad question. And obviously, I want to full disclosure, I don't know the future.
Yes.
Um,
Qualify as you will,
so,
focus where it makes sense. I think it'd be great just to understand, like, what are you seeing trend wise in the macro
okay.
market? What does that maybe mean for investors?
So I'll try to keep it quick because I could go on and on about this topic, but I'll share with you what I am seeing. And again, it could be flawed, and I'm more than willing to be challenged on those points and change my point of view. So for many years, we have had a lot of quantitative easing into the market. So a lot of cash, excessive cash, that made it into the market. So that cash obviously a lot of that cash made it so trickled down to the riskiest, asset, which is venture capital. So that influx of capital created a dynamic where the balance, sort of like the shift that you're seeing, went towards the entrepreneur. So what that means are faster raised with less due diligence, deal terms that were more favorable. So instead, usually you have like two, three, well, more than three, but let's say types of securities. You have equity, you have a convertible debenture, you have the safes and whatnot. So you saw more and more safes. So usually quicker, less due diligence terms and whatnot, higher valuation, whatnot. So as cash dried up, that pendulum is starting to swing back to the advantage of the
Mhm.
entrepreneur, the investor. What I mean by that is not necessarily sharkish conditions and whatnot. At, at least from what I've seen, I didn't see anything too drastic in that sense. It's just now investors are spending a bit more time doing due diligence. They have more negotiating leverage into their discussions to lead to better deal terms. They're able to better choose their partner and create the syndication around the deals because we never come on a deal alone, right? We always share the risk by having other deep pockets with other networks around a deal to create, a syndication that they risk your position as much as possible. Um, so that dynamic right now is very proper to investors to get better entry point and take more time to do the due diligence. And what we are starting to see in the market is this dynamic where you have a gap being created between the haves and the have-nots. So the companies that need cash to survive are not in a good negotiating position. So a lot of them, won't make it essentially. Just, there's an element of luck here where some companies just didn't achieve significant milestones at a given point that enables them to attract more capital. And as capital dried up, as that tide, went
Mhm.
down, a lot of people got exposed. Um,
Sort of the opposite of a rising tide lifts all boats.
exactly, exactly. So to take this analogy, let's keep sailing in the sea, right? Um, so this dynamic is very positive for us as investors, and it's actually a dynamic that you have seen after every single crisis. Capital dries up, and that creates very good opportunities for funds to because you have a very clear vision of the
Mhm.
haves and the have-nots. So I can give you, the example. I'm seeing a lot of companies still meeting with us, and they're essentially and you see those red flags, right? Bridges on bridges. What does this bridge leads you to? What I mean by a bridge is essentially a situation where you haven't necessarily achieved significant milestones. You're going back to market to get more capital, to extend your runway. So
Mhm.
the moment before you go bankrupt, to get to those milestones. But that means at the very beginning that you didn't you didn't achieve those significant milestones to start with. And on the flip side, you have companies that don't need to raise. Either they're cash flow positive, either they're well backed, or they kept growing during, the crisis. Um, and those companies are the one where a lot of money is pouring into, because we went from a mentality of growth at all costs to a mentality of survival at all costs. So that dynamic makes it so. And another element to this, we're looking at companies when the market was going up, people would get into a round that had 12 to 18 months of runway, because you knew the market would be able to sustain an increase in valuation over time, because everyone was just eager to put money to work. In this case, usually we tend to focus on deals that have 24 to 36 months of runway. So, and enough to actually do something significant that will attract more capital down the road. But what we're seeing more and more in the market is that the good deals attract more capital, because the capital still exists. It's not a crisis where capital dried up like in 2008, where some of the LPs literally said to their GPs, their general partners, who essentially the managers of the fund, don't do those capital calls. Don't call this money, because I need it to put somewhere else to work. In this case, what we're seeing is a lot of funds were raised in 2019, 2020, 2021, very beginning of 2022, and that capital needs to be deployed in the market. So even though we saw a dry up of capital in the few first months, or sort of like a 8 months ish period where the number of deals were decreasing, deal size were decreasing, that capital is still tied up and
Mm.
will flood back into the market at some point. So this is actually for us as a seed stage and pre-seed stage. So at the very, very beginning of the value chain, this is a very interesting position to be in, because if you are able to, pick the companies that are well heeled and well backed by deeper funds, or you're putting it into the radar of some other funds with the deeper pockets, this money needs to find outlets, right? Because they will
Mm.
need to go back and fundraise themselves at some point. So they need to see this momentum. So I come back to the initial point that I make. I think right now we're seeing this gap between the haves and the have-nots, and sort of like the companies that will get finance and will make it through the crisis, and those that won't. It's becoming more, clearer and clearer. So this is a very interesting dynamic to see. But again, I don't have 25, 30 years of experience in the space. I'm trying to rely as much as possible on the knowledge and the experience of people that have seen a few more crises. But it's usually the pattern that we see. The crisis drives opportunities.
Yeah. And that's part of what this whole series is about, right? That with the right strategy, with the right resource allocation, great businesses are made through recessions,
You
and
bet.
that also extends to the idea of community, right? So having people who have been through this before who can share experiences. So I love that you are, you're so humble. I mean, you have lots of experience, but that you are, talking about and highlighting the fact that, cycles repeat, patterns repeat. Other people have seen this before and can help put some perspective and insight to what you're seeing, and maybe an instinct you're having, that there is an opportunity to validate that with people who've seen it before, or with data, or whatever it might be. We're talking about things that are maybe a little bit more data driven here, but if you were to go into the strategy side, it might be a little more intuitive, but someone who's been through three recessions probably can give you a little insight.
Yeah.
Before we move off of the investor perspective, I mean, it'll flow through everything we're talking about, but if is there anything that you would say you are most excited about or most worried about, and that investors should be having in the back of their mind in terms of how to manage their risk?
So it's a good question. The way I would answer this question, I'm very, um, I'm actually glad to see the resilience of the Canadian economy. So starting with our banking system, you see what happened in the U.S. and what is still unfolding, and we don't know what is going to be the full extent of it. But I'm very glad to see this dynamic in Canada where the highs are not as high, but the lows are not as lows as well. So it creates, especially for us, the in deep tech, anything that comes out of research, academia, go through public funded incubators. So that whole ecosystem is very resilient, and I'm very glad to see our different level of governments, both provincial and federal, uh, being there and sort of creating that resiliency
Mhm.
in the Canadian economy. So that that puts even more emphasis for me on the edge that we have in the market as a very healthy, land, or a very, how can I say, very nice place to go build deep tech companies, right? So that makes me very, very hopeful. What I hope will happen is hopefully, sort of like an eye-opening moment where, we should go more towards the more conservative side of venture capital. But again, a lot of people will beg to differ with me. They will look at venture capital as this outlier, and only the biggest outliers should be backed. However, given that I'm funding Canadian companies, our outliers are not necessarily of the same magnitude as the U.S. So I got to be careful
Mhm.
with how I'm threading that needle, right? So I have to look at Canadian outliers and price my entry point accordingly, and then market and help those companies fundraise with the right funds that understand the DNA of the Canadian ecosystem, right? Or some companies that then could make it into the US and have that upside of a US VC backed company. But
Right.
all in all, I'm very hopeful for what is to come. And I'm very glad to see that our ecosystem is still in pretty good shape, actually. I don't know what the future holds, but I think this could be a pivotal moment to position Canadian ecosystem as a whole in the future as a very resilient, sound ecosystem to
Mhm.
build interesting stuff, and hopefully, talent at some point. I'd love talent to make it to Canada and sort of like create this counterculture of wanting more, building bigger and whatnot that the Americans are just so good at getting. Uh, we are very humble as Canadians, uh, and I think sometimes we could be dreaming it slightly bigger, but it is also part of our culture, and changing that is rather difficult.
Yeah, I mean, it's interesting. I know for myself that, as I've been through, the ecosystems in various forms, the perception or the reputation has always been that, the US, there's more capital, higher risk tolerance, moves faster, but there's also so much competition, right? Um, and then Canada is sort of, there are less players, there is overall less capital. I mean, we're just a smaller country, and the risk tolerance is definitely lower. I will say, I probably, I don't think I would say know enough to say like what that means for outcomes, you know, but um, but it's interesting to see, given how closely we operate and that funds do flow across borders, there
Oh, you
is
bet.
that
Yeah.
market difference in, reputational ideology.
I think you're saying something. I think you're bang on, and what you're saying definitely does resonate with me. So obviously, this dynamic in Canada, where because there's less money, especially at the seed stage, makes it so that we're not as competitive for deals, and that obviously, from an economic standpoint, drives valuation down. Right? We have more time to do the proper due diligence. That leads to sometimes lower valuation and whatnot, or lower entry point into the companies.
Mm.
But afterwards, I think we're there are funds that did tremendous job. I'm thinking about the white, especially in Quebec, the White Stars of the world, the Inovia of the world, creating those bridges between Canada and the U.S. to showcase what we have and the success story we have been able to build. So I think this cooperation, instead of competition, sort of like aspect of the Canadian economy needs to be uh, reinforced a bit more and highlighted a bit more as we're selling. I mean, our ecosystem into the U.S. because there are tremendously good deals to be done here at you know with sound businesses that are backed by levels and levels of government subsidies and whatnot, where we need to be what we need to be cognizant of, and where we need to be very careful as an ecosystem, is not to create, and again I use this analogy, not to create cage lions or zoo lions that
Mm-hmm.
wait for their steak to come in every single morning and lose that ability to hunt. That is sort of like the pitfall of every single geography where the government is omnipresent and where the companies get used to rely on external funding instead of doing the hard job of knocking on doors, getting being said no over and over and over again. To me, there's nothing like a company that has sales because they're
Mm-hmm.
able to send a very strong signal that the market wants the shit they're selling, and more obviously they learn from their customers, right? There's always
Yes.
this mentality with your first customers that will shape your product up to a certain extent, and you will just learn so much. So for me, a company that gets incubated too long in the lab lose that DNA or lose this chance to go learn the hard way into the environment of what it feels like to hunt and become a better hunter and co-develop with actual customers, paying customers, and go through the shit sandwich of like having late payments and
Mm-hmm.
not being able to scale with your customers and the political game that is being led internally that leads to very long sales cycles and whatnot. These
Mm-hmm.
are things that you do learn from in the books, but there's nothing like being face to face with those problems and creating the mechanism to solve them. And this is how, even as VCs, we tend to assess the level of maturity of a company. How much
Mm-hmm.
issues did you run into? How did you solve them? What did you learn? And so on and so forth. And that way you're able to sort of like get a good grasp of, opening up the hood and understanding how the engine works, essentially.
Right. I love that you said that. I think it's, yeah, how much reality have you been through and how much are we going to be with you for, right? Like you want them to have been through some level of what business is like, not just, I have this amazing idea and people will love it. But also what you said, it reminds me of, I had another wonderful guest who's, just a juggernaut in the space, has, been through 3 or 4 recessions. And she said, if it's in the voice of the customer, you can't be wrong. And I
Exactly.
think that really reminded me what you just said of that, which is until you are out there and you are getting rejected and you are getting feedback and you are selling and not selling, knowing exactly who your customer is and understanding what they want and finding that match, like is the only way that you're going to get that outsized return that you talked about, right?
Yep, absolutely. There are different ways to become an entrepreneur, right? People tend to think that an entrepreneur is usually someone that has this light bulb moment of like, aha, I got this idea and I got to launch it into a company, right? And I just haven't found the right idea and whatnot. It's not about the idea, it's about the problem that you're solving. And some of the best businesses that I've seen actually started out as almost a consulting gig in the sense that they start working one to one with a customer almost as a consultant and sort of like co-developing or co-solving a problem that they had as consultants. So that way, you do get a salary, so you don't need to launch everything and launch yourself into the void and hoping to build a parachute as you're falling down, right? Because you do have that consultancy money coming in. You already have your first customer. May take a bit longer. You got to make sure that you can productize it to other customers in the space. But very often, if you made your homeworks correctly ahead of time, um, you will be eventually able to pivot or change some features of what you have co-branded or co-built, I should say, with that first customer, that initial customer, and then see whether or not it scales with other ones. But that proximity that you have built for the future years usually translates into a better understanding of the pain point you're solving and then enables you to scale your business much quicker afterwards. So that is, one of the many patterns that I see that, usually leads to a higher success rate. Usually the pitfalls of this model is that you stay or you remain a consultancy, a gig, right? Or you're not able to, create a solution that's wide enough to attract different customers in the space. But people got to stop thinking about I got to have this tremendous idea. just pick a problem and solve it, right? Just find someone that has a problem that is willing to pay for you to solve it, and that tell you ahead of time, you know what? If you're able to solve this shit, I'm giving you $500,000 a year because it is worth so much more to me.
Mm. I love
So
that. It's about the pain point,
yeah,
not the product or the idea. I think that might be the
exactly.
title of this episode.
Well, you got to fall in love with the problem, not with the solution. And that is the problem in my space, right? I'm meeting with so many PhDs that are working on something for years. It becomes, they're like super deep into something super narrow, and they're absolutely convinced that the market will want what they're building. But the truth is, it is so far from the reality, because what they have develop is in vacuum. It
Mm.
doesn't take into consideration, the real traction. So very often, and I'm using this to open up the door to, a way that I'm looking at businesses. Very often, whenever someone technical comes pitching to me, I use a black box approach, where I will take for granted whatever, technically they tell me they're building, and there, I'm asking questions on the business side. I'm asking whether or not, how the market is reacting, and I'm just listening to their questions, because the truth is, I'm a mile wide and inch deep in terms of sector expertise. So we became better at asking questions and listening to answers, essentially, to assess whether they're forward, whether they're backwards, uh, whether they know what they're talking about, and their level of understanding of their own industry.
Mm. Yeah, I think that's such a great transition into the question of I know we have a lot of entrepreneurs and founders and people here listening. So the fundraising and pitch process is notoriously like scary and difficult and intimidating. And we hear about a lot of things, and I would love to talk about how vital storytelling is and all that kind of thing. But just maybe first off, can you just give people a perspective on what you think are the top three critical things for a founder to know and nail going into the attempt to raise venture capital funding?
So the first and foremost, we touched on that briefly during the very first part of our discussion. I think the very basis is establishing a rapport with the individual you're in front, right? Uh, See it as a both-way interview. As much as I'm interviewing you in your business, and whether or not, I want to work with you, I want to feel sort of like the same sense on the other side, that, I value what I'm building. Do I want to work with you as well? That changes the dynamic from one where, you almost have an imbalance in the power of the individual. The very good entrepreneurs, and usually the one that we end up investing with, create a rapport naturally, where, there's not someone being over leveraged the other, because that does not create healthy relationships down the road, right? So already being able to put yourself in a position where you're not begging, you have something cool on your hands, you do, and you're looking for partners to help you get to the next level, right? So already that changes the dynamic. Afterwards, another element, there's nothing like sales, and there's nothing like customers that I can call, pick up the phone, and ask me, you've been working with this girl, with this gal for years. Tell me about, their solution. Tell me about what it's like working with them. And you pick up the phone and they tell you, I had this problem for years. I looked around. There's nothing like it. I use it. I'm a huge advocate for what they're building. This is the kind of traction you want to hear. So you can sell me your grand vision as much as you want, but having those phone calls are usually a tremendous tipping point into, making us more comfortable into the investment, because there are no experts like the customers, right? Because they feel that pain point on a daily basis. I will never get to the level of understanding of their businesses that they do. And for me to hear those raving reviews are usually a very good sign that, they nailed it and they have something on their hand. Afterwards, so sales, just a human relationship. And afterwards, don't push the process, in the sense that leave it some time for the relationship to build. I know You are on a very tight timeline. You
Mm,
need to fund, uh, but create a relationship with the people. But on the flip side, make sure that you get to a yes or a no really rapidly. Our industry is extremely well known for maybes, which I personally hate because you're losing everyone's time here. Because the VC gets the optionality of dragging their feet and seeing whether or not they can squeeze in and say, "I always believe in you," right? Just at the right time, like the Indiana Jones movie where he's just grasping his hat as the door closes. A lot of VCs are like that. It's like, okay,
mm,
well, I don't want to lead it, but now that you have everyone involved, I'm willing to be like investor number 12 on your cap table, and I've always been cheering for you. Honestly, that is, I know there are a lot of VCs like that, but try to make sure as a founder, to get to a resolution, a yes or a no, because your time is the most precious commodity that you own as an entrepreneur. So you got to make sure to invest it correctly. So that's sort of like the last advice. And then on the pitch, there's different styles. Make sure to understand whatever works for you. Are you more of I need to have the pitch deck to share with you what I'm working towards, or you're more someone that establishes a report, a conversation, and you're able to drop tidbits of information. And understand, we're coming back to the dating analogy here, but understand that on the first meeting, you're selling the second meeting. You're not selling, I want to wed you right now on the spot. You got to make sure that you're not pushing things to a level where it creates discomfort on both sides. You don't want you and that is something that entrepreneurs have to listen to them internally, how they want to create their relationships, and listening to the feedback or what is being said on the other side, right? To create this dialogue between individuals.
mm. Love that. What could you say about maybe like storytelling is something that we talk about, a lot in terms of pitching, right? It's you can't just come with some facts. You can't just come with a tech. Like you need to tell a story. And I'm curious whether, has that changed in the current climate? Um, and if not, has maybe the story that you need to hear changed?
No, nothing has changed. And if I were to go on a limb, I would say nothing will change.
Mm,
Storytelling is the very basis of humanity. We are storytellers, and
mm,
storytelling is selling. So no matter what, the story you're telling, what you are painting as a picture is up to you, the entrepreneur, in the sense that you have your business, you have different elements that compose it. Uh, it is up to you to create a story, a narrative, and you have the chance of driving the narrative, understanding where the pitfalls are in your stories and whatnot, and sort of like guide it and weave it into something that is inherently, depicts your company quite well. So
mm,
the art of storytelling is probably, and selling in general, is one of those skill sets that is rarely, very rarely thought out in school, but it's just so powerful. The best
mm,
salespeople are just people that are able to establish this rapport through their storytelling, through what they're telling and how they're listening. Good storytellers are usually good listeners as well. That are able to sort of like change your story based on the reflection, reciprocity that they're building with the person in front of them. So the very good pitchmen and pitchwomen, the very good entrepreneurs are able to weave their story based on who they have. So they have a narrative that composes like 80% of the backbone of their story. It's almost a cassette that they're playing, and they know they're going in direction A, direction B, and afterwards it creates this arborescence, essentially
mm.
this mapping tree of different options where you can play cassette A, cassette B, cassette F, cassette. And for the younger audience, a cassette is essentially something you put and press play and it plays by itself. So see it as MP3, I guess. Um, But yeah,
Thanks for
it's just
aging us.
it is almost rehearsed to the point, and even I could share with you that the discussion we have been having so far are cassettes that I'm playing, are things that
Mhm.
I've already said before that I'm reusing essentially, and we're
Mm.
all doing that whenever we're telling a story, right? We have the backbone, we have our narrative onto which we can play different elements to compose something that makes sense for the discussion we're having.
Right. I love that. I think that's yeah, it's great to relate it because we all have that like story, right? Like when someone asks you what you do, or you have the pitter patter of like the main steps, but then based on who's in front of you, what's more important or interesting to them will guide kind of where you spend more time.
Yep, the infamous elevator pitch, right? Every single entrepreneur gets drilled into their elevator pitch, but think about it. It's the thing you will probably rehearse the most. Whether it's your aunt at Christmas that you need to pitch, what is the startup you're working in? Young entrepreneur, and you got to tell them within 10 seconds what you're building, or you have this elevator pitch, whatever. You're meeting someone at a conference that is someone you want to work with, that you have identified you want to close business with. You got to hook them in 10 seconds. So how you do it? You keep your message rather concise, super clear, and you adapt your message to whoever you have in front of you. So obviously, you wouldn't use the same technical language with someone from the industry as you would with your aunt. And for the more technical founders, one advice that I keep giving is make sure not to dwell too deep into the technical right away, because VCs are known to have a very short attention span. Just because we see so many pitches, we tend to zone out whenever we're recognizing that this doesn't fit some of the patterns. So a good narrative usually is one where you are creating that ping pong, but you're able to, whenever asked a question, you're able to answer it with a level of conciseness and in a synthetic fashion that shows a grasp and an understanding of your
Mhm.
industry in such a fashion that you can then come back to a more high level narrative afterwards. But the way you answer those technical questions uh, give you that ability, that read into the level of understanding, and then you're coming back. So it's always playing, those. I see entrepreneurs that stay at the very, very technical all along. And I'm like, okay, well, this is a technical founder. Can he actually, or can she actually get to this level? Or I see the opposite. It's like, well, whenever I'm asking a question, this person is shallow at best. They don't know their industry, and why should I be trusting them? And to
Mm.
having this sort of like ivory tower vision of where the market is going if they can only go this deep, right?
You're too good of a salesperson, not technical enough.
Exactly, and we see that very often as well.
Yeah. I'm curious. I mean, we're talking, we're talking about elevator pitch and storytelling. So, let's throw more jargon in. Value proposition. You
Yep.
talked about, VCs are notorious for maybe dragging their feet, for being the last one in the door. So what you're saying is that you need to incentivize a fund partner to make a decision, right? To take the leap. And I'm curious if there are certain value propositions um, that are resonating more, or whether value propositions are shifting in this recession. Are you looking for something different, or it's the same kind of process and perspective?
uh, it's a good question. Some firms will be notorious on being thesis driven, and whenever they invest into a company, that sends a signal so strong to the other investors that you know uh, this company has a bigger chance of attracting bigger customers or attracting more sophisticated capital afterwards, because that VC comes with a branding and a market signal that sends a very strong message to the market. Others will be more on the operational front, a little bit like PE firms, right? Where they come in, they're known to be operators. Well, they surround you and with
Mhm.
talent to essentially bring you to the next level. So that will be a different brand, right? Where I'm personally trying to play with Boreal, being more of my thesis being so broad, because my thesis being uh, fixed to the Canadian geography, I needed to have a thesis that is a bit more broad, right? And working with the different, government-backed incubators that are already doing a very good job at the coaching and the operational side of businesses. For me, where I'm trying to build a brand is into attracting capital. So essentially making sure that whenever we work together, I open up my Rolodex and I try to be as transparent as possible. Either I'm in the deal or not in the deal. Just showcasing what Canada has to offer, what Quebec has to offer, what is good, and just creating those bridges that afterwards you can, create a better relationship with other investors that will further on decrease your level of risk exposure to the positions you're in, because you're able to find someone else to put more money to work and then creating a bigger pocket of capital around the businesses. So I'm
Mhm.
not an operator. I whatever operational advices I'm giving, I have myself to take them with a grain of salt, because I've never really operationalized a business. I've never been a CEO. I've never scaled a company to an IPO and whatnot. But what I'm trying to build is this network of people where we're sort of like at the very center of knowing who are the right people to help you scale the business and making those introductions ahead of time. So
Mhm.
not only does it, help us in the due diligence, afterwards, those introductions, if they're in, will send a very strong market signal by themselves and will come with the additional operational help and whatnot that is needed. So the brand that we're trying to build is one where we're as connected as possible. And, we may not know the answer, but we know someone that will. We may not know, which question to ask in this case, but we know someone that will. And trying to bring them into sort of like this pool of HR. So it's a very HR approach to
Yeah,
investing, right? Of
connected and
becoming
collaborative.
exactly becoming sort of like the hub of a spoke model where you have an ecosystem of people that know that you are a good judge of talent, and that you only work with tier one talents around you, and that whenever you're pulled in, there's another person in another field that is just as good as you that will get pulled in into another deal. So this
Mhm.
is the brand that we're trying to build, is being a very, very good read of talent. And again, this is something that will take years to prove, but it's about uh, building the best teams possible. And that is not only operationally, but also on the financial side, and also, repeat angels and whatnot.
Right. So, I mean, you're talking about operations. I'm going to transition. Let's say, companies are in your portfolio or companies are in any venture capital portfolio, even for someone who maybe doesn't have investment, just thinking about the leading practice.
Hmm.
Have expectations of your portfolio companies changed in the current environment? For example, burn rate is always vital, longevity is always a win, but has your expectation or your advice to your portfolio companies changed in the current climate? And if so, what are kind of the highlights of that?
I'm I'm lucky in the sense that I'm a very conservative investor by nature. So I'm
Mhm.
very conservative for venture capital. Uh, so my vision has always been of companies that have solid foundations onto which we can build and augment. So crisis or not, those are businesses that are rather resilient in nature. So for us, we weren't that impacted, and I'm knocking on wood that we won't be, but that makes it so that in bullish market we may not be as bullish as some other funds and whatnot. So
Mhm.
we could say grand lines that I'm seeing these days is that the growth at all cost mentality is starting to fade out towards you know going back to the opposite side of the spectrum, raise more, longer runway, growth at all costs is dead. Just survive. Make sure that you can still grow and not lose meaningful customers, because that will be even worse. So there's the shift in mentality. Um, but the truth is, those companies that are also in the in between, that are not necessarily fast growers and did survive, but at what cost? Uh, these will be companies that will be hard. Uh, you know, uh, Hopefully they're doing so. They're surviving, so they are surrounded in a field full of companies and startups that died essentially, and that creates an opportunity for them afterwards. But you got to make sure that there's a growth plan ahead of that sort of like survive phase, and that you're doing so to the extent that this will give you a strategic edge down the road, because other companies didn't make it through the crisis, right?
Mm. Yeah, I want to just follow that up because I think you sort of answered this question, but I know one of the perspectives that is common, not everyone shares it, but that there's this balance, right? Of, obviously at any time, but particularly in a recession, if you are resource constrained, what is the balance between, longevity, as you said, conservatism in spend and in investment, but also having priorities for growth and also taking advantage of opportunities that can come up through difficult times. As you said, companies may not make it, technologies may become available, you know human capital may become available. So what's the balance between kind of being conservative to ride out the storm and investing and taking advantage?
So I think you said it very well. There's no giving answer to this, unfortunately. It's it is up to the entrepreneur and the board and the investors surrounding those entrepreneurs to make the right decisions. But tier one talent is tier one talent. They're the very foundation of what you're building. So if you're able to attract someone that does really move the needle, you will see it in some way, shape, or form within your business down the road. So this will be an investment towards the future. That makes sense. Then, strategically, you got to make sure that the opportunities that are ahead of you still fit within the boundaries of the vision that was set by the founder, and not get distracted. This is, the downside of this dynamic is to get distracted and then don't deliver onto the very basis that what made you, special in the first place. So this whole idea of focus still remains. But when it comes to talent, for me, talent is, especially as we're in a declining demographics. Talent will always be the very most important thing within businesses. So if you're able to get tremendously good engineers or salespeople or operators for your business, because those people are available, see it as an opportunity, because these will be giving it back to you tenfold, if not more, down the road. And you're creating a mentality, you're creating a, how can I say, a culture internally of excellence by attracting nothing but the best. And this is what usually the some of the better company I invest in are able to do, is becoming very good judge of talent. So this is something else that within my due diligence process, I'm indirectly poking for. So meeting up with the team and you know, are you a good judge of talent? Usually is a good sign. The best entrepreneurs have very high standards, and don't take B players within their team, because B players then attract C players, and then it's a downfall from there. So the best leaders usually are able to attract top tier talent, and that is the biggest opportunity right now with the crisis, I think.
I love that. I want to end on that. I think that is the biggest opportunity, is to find amazing people that will help you take your vision to the next step. So that is a lot about what this series has been about. David,
On
thank
this point, very specifically, if I may add,
yeah.
good entrepreneurs are usually generals. They're army generals, and they're building an entire army of people that you're able to incentivize them to build your vision. So think of it as building a dream team around you. And I know this gets thrown around very often, but uh, see yourself as trying to incentivize people into building something that you have in mind. And the good entrepreneurs really do it well.
I think that's I'm gonna add on your ad. That is where entrepreneurs become leaders.
Yeah, exactly.
Yeah, like,
So
and
that's
that's
it.
the key. David, thank you so much for joining us, for being so generous with your time. We've had a great discussion. They do tend to run a bit long when we get into them. So is there if anyone does want to know more about you or potentially get in touch for some kind of collaboration, what's the best way to connect with you?
LinkedIn. Honestly, LinkedIn is the best place. Usually, my LinkedIn inbox gets more attention than my inbox itself because I receive way too many emails. So this one is a little bit more, I receive less inbound, so it's easier to manage this way.
Amazing. Thank you again for your time. Thank you for everyone who joined us live, and definitely excited to, see where things go.
Thank you for having me. Thanks. Bye.
Bye. Thanks for tuning in. Our goal is to create connections and inspire conversations. So please subscribe, rate, review, and share this podcast with your network if you enjoyed today's episode. Sharing is caring. If you're ready to take your business to the next level and are curious how I can help, click the link in the episode notes to schedule a call. Got questions or topics you want us to discuss? Click the link in the episode notes to share them with us. Your question might even get featured in an upcoming episode. And remember, this podcast is not intended to replace legal, tax, or other kinds of professional advice. Thanks for joining us on this adventure. We'll catch you on the flip side.